Hello value investors, thank you for joining me. In today's video we're going to talk about price versus value. So if you're new to the channel, please subscribe now so you can get my next value installment. The topic of this video came up because on my marketplace on Seeking Alpha I talk about this difference in terms of what an investor can expect when they buy into an asset. So at this moment in time, markets are just rallying off and there's a large discrepancy between companies that are kind of like quote unquote new era and the more traditional investments. And I haven't seen this like this before, that you have things very frequently trading at 15 times sales, 20 times sales with no profitability. Many of these investments that are kind of positioned themselves to be digital companies, e-commerce, and they're trading at 50 times sales. Now that's not the end of the world, because what makes it even worse is that you have this decelerating revenue growth rate. So they were doing quite well 2015, 2016, but since approximately 2016 you can see a very slow progression, the revenue growth rate decelerating. So some of these businesses have been going from approximately, let's say, growing 50% year over year, then 45% year over year, 30% year over year in 2019. Now, in 2020, many of them are saying, okay, we kind of did quite well in the first part of 2020, but we're going to pull our guidance. What that's telling you squarely is that management isn't confident how the end of the year is going to unfold. So many investors are paying a large premium, a large price for the company on the expectation that what they were used to in 2019 when the economy was strong would continue. That is not going to continue. That's just the reality. We already saw when in 2019 the company was already coming to maturation, let's call it. Already kind of revenues were kind of a bit more challenging to come by because they had expanded quite significantly, and now you're in a position where they pull their guidance, you kind of in this limbo. When the results come out in, let's say, Q3, you kind of think, okay, yeah, it's not the end of the world, because yeah, we were expecting things to be rough. They were rough, but it's probably not the end of the world. The business probably still okay. The business is not going to be okay. So that's the thing between the price and the value. So the best investment in the world at the wrong price is not going to work out, right? So you got to go back to your basics. You got to be willing to buy an asset, a free cash flow generating asset. I've got a video about free cash flow, it's quite helpful. A free cash flow generating asset, and you're not paying a large multiple. So the price that you're getting should be lower than the value. The value is very, very important. Without your core understanding of intrinsic value, I've also got another video about intrinsic value. Without you understanding what you're actually getting, you're in a difficult position. Many investments people are saying, okay, this investment is not that shockingly priced because its peer is higher. It's the valuation at peer is higher. No, I'm saying the multiple of the peer is lower. The share price is higher. So that business is more mature. For instance, let's talk about, just for comparisons, Snap versus Facebook, okay? So Snap is an advertising business, and I have no position in any of these companies, but its multiple is fairly extended. You're kind of paying approximately, off the top of my head, let's say about 14 times sales, thereabouts, trailing sales. So there's a high expectation that business is going to take off. And many people say, well, Facebook is high. Yeah, but Facebook makes the freaking load of free cash flow. So, I mean, and if you look at the multiple for Facebook, it's approximately 9 times free cash flow. Now, in my experience, running through the businesses that I know, very few businesses in the world can transfer as much free cash flow out of their revenues. Off the top of my head, I believe that they have a free cash flow conversion rate of approximately 40%. That kind of means that for every dollar that Facebook makes 40 cents of just pure free cash flow. That's just like, do whatever you want to do as a business owner. So that just ends up on its balance sheet. It has approximately, I don't know, like 42 billion. as debt-free. So it's kind of like you can't compare. It doesn't compare. You have a business like Snap that it may or may not become profitable, significantly profitable, to warrant that approximately 25-30 billion market cap. So it looks, the share price in terms of market cap looks cheap in comparison to Facebook, but the value that you get out of it, there's no value, in my opinion, in something like Snap. You may watch this video 2 years on and it's gone from 30 billion to, let's say, 150 billion. I don't think that's the case, but things do happen. But you have to be willing to be, as an investor, you got to be willing to be prudent. You got to be willing to be selective with your investments. So this is something that I talk about in my marketplace. There are many, many businesses I come across. And some are like kind of interesting, that could work out, like Facebook. I have no position in Facebook, but that's something that could work out. But you got to be really, really selective for, because at this moment in time, you see the markets are just rallying. There's I don't know if you remember, but coming in March 2020, it was just mass selling. People were just selling, irrespective of valuations, irrespective of anything. It was just sell first, ask questions later. And today, it's like the opposite. Buy now, and maybe things will work out positively. It won't work out positively. There is no way that a business, without any way to become profitable, sustainably profitable, is worth 20 times sales. It's just not happening. Many of these businesses are positioning themselves as software as a service businesses. So you got these type of businesses where a portion of their revenue stream is recurring. They're locked in their customer. They might be locked in for, let's say, a year. That's very attractive. The rest of the revenue is value-added services. This can be like onboarding, consulting services. So this is just a one-off recurring revenue stream. When the customer comes in, they kind of have these little add-ons, but that portion has very little value. The reason why it's very little value is because it's not recurring, and it has a large amount of costs associated with that. So if not all businesses segment that out, but the businesses that do segment that out, you can see that their gross profits from those value-added services, they kind of call them something differently at times, but you can see one is the recurring. You got your ARR, which is annual recurring revenue, or they got different names similar to that, but you kind of understand what I mean. And you got the value adds. So the value adds are pretty worthless. You kind of like, but what the company wants you to, as an investor, to think about is a total consolidated revenue, and to put a, let's say, a 15 multiple to the sales. But remember what I just told you. The bulk of that revenue is just non-recurring, low profits. What is attractive is that where they really got your customer locked in. And that is a nice revenue stream, because the investor is highly predictable. That asset is highly predictable because they lock that customer in. I have no position in Salesforce, but for example, Salesforce, they got the customer in, they're locked into, let's say, a 1, 2, 3 year contract, and it's quite unlikely they're going to move off the platform. It's taken a lot of education to understand how it works, how it operates. They're comfortable with it. Many of the company-to-company contacts are working with that, so that makes a lot of sense. Okay, that is very attractive. The rest of that business is not very attractive, but it's not only Salesforce. There are many businesses like this. So I just want to drive home. It's very, very important to understand the difference between the price and the value. And this seems a bit like kind of things seem to be a bit carried away with each other. And I think that by having this in your mind, understanding that when you invest, you're not a speculator. You're not looking at the share price. The share price is doing well, therefore it's safe to get involved with this investment. It is not safe. That is not the right approach to it. It's very important to explain that looking at the share price and hoping that momentum is going to carry it forward is going to work out profitably. It won't work out profitably. And we saw just a few months ago, when selling comes, it comes. And there's nothing you can do. And is that fear in your gut of whether I should wait for a better moment. So you don't want to be in that position where you bought an asset, the asset is sold off by 25-30%, and you're just seeing it go red day after day after day. You just -5, -10%, and you kind of like, Is it going to come back up or is it not? And you don't want to be in that position. So I want to really drive home the message. Think about the value of your business. Think about the free cash flow. Think about how stable and predictable the business is. Good luck.